All right, all right, all right. Good morning, everybody. Good morning to you, John. Walk up. It's
Hey, good morning,
beautiful.
Noah.
Kick off the fall season with gorgeous weather. I love it. It's been a while. Have we not been here for a few weeks? I feel like it's been
It feels like it. Well, because
a couple
last
weeks.
week was Labor Day, which was great,
Mm.
and now we're back at it.
Back
So
at it, doing our thing. Hopefully, you guys missed us just a little bit.
a little
Hopefully, you
bit.
guys need a little macro Monday. And we're going to get started right over now. All right. Hello,
I
everybody.
missed
Thank you,
you,
guys. I miss you too,
like the
Johnny.
like the desert missed the rain. Was that Sade? And I
I
miss
don't,
you. Remember that one?
I don't know. I don't know. I don't know
Like
if that's
the
it.
missed
Got
the.
Johnny's already going off the rails over here,
I'm
guys.
going.
I think we lost him.
I had my
Johnny's gone.
coffee.
All right, everyone. We're just messing around a little bit to get some people on here. That is John Walkup. I am Noah Rosenblatt. We are both with UrbanDigs, and it is Monday. You guys are going to get a little macro Monday coming right at you. For those of you that are new to this show, we're going to start out with Manhattan real estate, go over a couple of monthly trends, and then we're going to show you a bunch of macro tabs. We'll go on credit spreads. We'll go on rates. There's some stuff going on in rates. Definitely stuff going on in rates. And a couple more macro stuff. And we'll try to circle back to Manhattan real estate. And we're going to attempt to do all this in 30 minutes or less. Don't know if we'll be successful or not. We'd love to hear you guys' comments. We check the comments. Please, please, please ask any questions you got. Don't ask us about trading advice, guys. This is not financial advice. This is not trading advice. Do not day trade any of the stuff that we're talking about, because we're really talking about tradable markets in this show. Okay?
It's going to be a roller coaster of awesome information.
Are you ready? Are you ready?
Yeah.
Let's rock and roll.
Are you asking me? I'm ready. I'm here.
Okay,
I'm ready.
I'm ready to rock and roll. I want to start with the monthly trends, guys. I want to look right over here in supply. Let me show you where I'm looking. I'm looking right over there. Okay, so you can see where I'm looking. 1,031. Okay, 1,031 is our 30-day trend. But if you look at the little 30 bars that are over here, that shows you every single day's activity, which is kind of cool. We are just in the beginning of the listing season. It actually started. So we're about 4 or 5 days into the listing season, whether you know it or not. This number, this 1,031, is supposed to end the month of September at 1,757. 1,757 is the average number of new listings to come on the market in September. It's our number one listing month, John.
Well, because it's so compressed. You get all of fall basically in 3 weeks.
Yeah. Versus the spring, where you got April, you got March, you can mix it up a little bit. Yeah, I got you. The fall season is definitely shorter than the spring season, so that makes a lot of sense. So we got a lot of upwards momentum on this. I wonder if that will change given our local climate in Manhattan with the mayoral election specifically. Are there going to be sellers that just say, let's sit this one out, we'll come on in spring? Or whether or not the listings are going to come on? I don't know.
That's a good question. It remains to be seen. So, but I mean, look, if you're waiting for the election to decide, so when's the election? Early November. It's like, do you want to list in mid to late November?
No.
You may put that on in the spring, but at that point, you're already several months, down the line.
That's the question. Is it fall or spring? Like you're not listing in November. Do not list in November and December. That is not a good strategy. I know listings do come on, but that's our off season. Okay. Anyway, so we got 1,031 in terms of supply. That's supposed to be at 1,757. So we got some upwards momentum there. This is at 718. Contract activities at 718. That is supposed to end the month at 707. So we're a little bit above that now. I don't know if we're going to beat that number by the end of the month, but just know that this is not the month where the deals really, really happen. This is the month where the stuff comes on. And then towards the end of September, October, November is when those contracts get signed.
So. Yeah, and that's what makes September always a tricky month, especially when you're trying to parse out trends, because you get a ton of listings coming on, and then it's always quiet on the contract side. So if you're trying to get a sense for who's got the leverage advantage, you think, gosh, there's so much supply, but there's not a lot of buy action. It's always tricky. So this month is just really tricky, especially given the fact that we don't know what that fall trend is going to shape up to be. Hopefully we'll have some clues at the end of this half hour, but we'll see.
Yeah, we're also going to need a couple more months of data to come in. But I mean, if you take a look at liquidity right now, deal activity, liquidity, it's just, we're at the top end of the low liquidity range. That is not really a strong strong showing. And if you go to the chart room over here, and if you look at climate index, the climate index is also very, very low. So it is a challenging listing climate for sure that's going on in Manhattan. So those are two things we got to keep an eye on, okay? Listing climate and deal activity. Those are the two elements. We will be all over that, guys. All over that for you. Just keep staying tuned and we'll tell you everything you need to know on that. I want to pivot. John, I want to pivot to credit spreads, okay? Credit spreads is our indicator of whether or not risk on, risk off in the markets. If you look at the stock market, it's just, I mean, you can't stop this thing. Can't stop this train. What you need to know about credit spreads, take a look at this blue line right here. As it goes up, okay, let's transport ourselves back in time to this little April Liberation Day element. As it goes up, that means it's risk off. That means credit stress is rising. You do not want that. If I do max on this chart, you could see the great financial crisis up here. You could see the pandemic up here. We want low credit spreads. We are low, right? We are low, and that's kind of explaining this whole risk on in the stock market. But I just don't see anything here that would warrant like worry or concern or that there's a stock market crash about to happen. If that was the case, this would be going up, and it's not.
Yeah, I mean, we're on sort of a long-term downtrend. You can go back about 6 months. I mean, it's just working its way down. You get these little ticks up here and there, but you're right, Noah. This is basically pointing to continued risk on. I mean, you look at the peak there on the sort of the middle third, and then it's just been working its way down. You get a little up, and then it just kind of works its way down. So you get lower highs and lower lows kind of thing, which in terms of credit spreads is great because they're compressing, which means that, you know, more to the point that people are searching for risk to get yield, which is interesting because you think about things that are supposed to be hedges against risk like gold, and they're at record highs. So it's like you have a couple of interesting metrics here that aren't necessarily telling the same story.
It is really interesting. It's very confusing times indeed that's going on right now. This credit spreads right now, which is the difference between corporate bonds and basically safe U.S. government bonds. That's what the spread is representing here. As John is saying, it's risk on and there's nothing to see here. It's low. If I click max, you see kind of how low we are. But John, you mentioned gold. I don't know if Brian Morgan's here today. Brian, if you're here, you got to go speak up now. Anytime you hear gold, I think of Brian Morgan for some reason. But look at the move that gold has made. What is this telling us? I mean, does anyone have any thoughts on what this is telling us right here?
So can I raise my hand on that? So I look at this as sort of the inflation hedge, which is the idea that even though we're not quite seeing the signs of inflation coming through the pipe, I think the price of gold indicates that the worries are still existing out there.
So you think this is an inflation-driven element going on here? Kind of the Fed printing money, inflation, that kind of thing.
That's sort of my takeaway on this. And the idea is that, you know, the value of a dollar today, according to what gold is, might not be the same. A dollar today might be worth more than it is in the future.
I mean, yeah, it's definitely a debasement of currency situation. I always look at gold as like faith, global faith in central banks in general, because central banks is where they print all the money, right? It's not just about our central bank. There's other central banks going on out there. The print press goes crazy. But when I see something like this, I wonder in the back of my head, is faith in central banks, confidence in central banks declining? That's what I keep thinking about. I don't know.
Well, I mean, so that's a completely different argument, and you could talk about that as well. I mean, I think there's been some rumblings in the press that, you know, maybe the central bank, especially here, the Fed, might be a little bit more under political pressure than a lot of people might like it to be, and that could be influencing this price. But I'm just going to take the broader view and say there's worries about basically the monetary deflation, essentially the value of a dollar going down, hence gold goes up.
Yeah, it's interesting anyway, just to see what's going on in these precious metals. Silver's doing the same thing. I mean, they're getting to levels that we just have not seen in a long. Well, silver, I've seen crazier times in the 70s, but gold is just hitting new records. And you take a look at a chart like this, guys. I mean, it is Macro Monday. We are talking about macro stuff. That yellow line is gold holdings from foreign central banks. The blue line is U.S. treasuries of holdings of foreign central banks, right? So you think about central banks and foreign central banks, they're they're selling U.S. government bonds. They have been for a while, and they're buying gold, and they have been for a while. And this has been going on for years. And here we are. And for like the first time in a long time, that there's foreign central banks have more gold holdings than U.S. treasuries. It's just interesting.
Yeah.
What does it mean?
I mean, it was such, well, I mean, for the longest time, right? I mean, this chart goes back to the 70s. So it's like you look at that long downtrend, which started in, I guess, 1980 and lasted all the way to the early 2000s. Then it kind of bottomed out and started ticking back up. So it's interesting to see this sort of long-term, I don't know what you want to call it, cycle maybe? I don't know how secular it is, trending back up at the same time it crossed over. So I'm not placing a lot of weight in the idea of a crossover. It could just be a coincidence at this point because who knows? But it's interesting. It's something to pay attention to, but I don't know quite what it means.
Yeah, it's something new, and I don't quite know what it means either. And I was hoping someone in the audience would kind of share some thoughts on what's going on. But this is definitely meaning something, guys. This is meaning something, and gold going to record highs. Silver making a move up. I mean, this is definitely something. Either it's a fiat currency debasement element, or it's a decline in faith in central banks. I don't know, but it's definitely something, and we're probably going to find out after what it all means. But we're pointing it out now to you guys. So that's that. All right, credit spreads. In terms of credit spreads, I don't see any concerns. So I don't think there's anything risk off going on right now. It's still risk on going on in the risk asset markets going on. I want to talk about Fed, Johnny. Fed, this is the Fed Fund Futures. I just moved it up over there. I am at the CME Group Fed Watch tool. You guys can do this yourself. We look at this every single Monday, and this is going to be our guide into what the markets expect the Fed to do. That's what this is, and that's how you talk about it, right? You say the Fed Fund Futures is the markets. The markets are expecting this, okay? And we just read the table. What I see on this table is that we're not there. That was a mistake. We are here. We're at 425 to 450. It's not even on the table.
Yeah. No, it's not even on the table. I think
on the table.
Yeah, we've had there's, for the longest time, it was the question of, does the Fed have to stimulate the economy or do they have to fight inflation? And, given the jobs report that came out, I think the entire consensus has been, we're going to support the economy. So this whole thing has shifted down. And you'll notice, far left, all those little white boxes started opening up. So I think the bottom went out, what is that, 175 to 200? So that's 1.75 to 2%. So now, I mean, it's very, very small, but you have some market participants out there saying, well, I think the Fed could go that low. I don't think it's going to go that low, but I mean, look, they're pricing in, it's 90% certainty that they're going to be cutting on the 17th, which is what, next week, I think. There's even the remaining percentage is like, actually, it's going to be 50 basis points. So again, I don't necessarily want to fight against that tape. It's still a week away, but it looks like there is a rate cut baked in here at this point, Noah.
Yeah, so this was the jobs number. A jobs report came out last week that was softer than expected, right? Whenever these economic numbers come out, there's a consensus of what they expect, and then there's an actual. So the number came in a little soft, and what happened is, guys, rates just went straight down. This is from last week, right? We didn't have Macro Monday last week. Rates just went straight down from that jobs report because now they think the Fed is going to cut more aggressively. This just changed, right? So let's just read the tape, and let's show you guys what the markets are expecting. The next Fed meeting is September 17th. I'm a little off today.
You're stuck in the future. I get it.
The next Fed meeting is September 17th. There is a 90% chance that they're going to cut 1/4 point down to this level here. Okay. That's pretty persuasive. I think that's cut's coming.
That would be a big surprise if it doesn't turn out to be that case. So
if they don't cut, the markets are going to just adapt and react in a sharp way. So I think they're going to cut. You don't want to mess up with the markets. The future meeting date of October 29th, they got another cut. 75% chance we're going to cut another 1/4 point. These are all 1/4 point moves, guys. Each one of these little step downs. December meeting, another cut. So now we got 3 cuts And look at the percentages, guys. 71, 75, 90. Remember I told you guys a long time ago, there's two things you got to be careful of with this table. Okay, just be completely honest with you. Number one, time. Time. I don't like to go further than like a few months because things, I mean, last week we had a report and it all changed. So you don't want to pin your reputation on too much. And if it's further out in time, like December and January, it's like, I don't even want to touch it. All right, time. And then this number, the confidence level, how high is it? So now you got 3 cuts above 70%, John. That's the first time I'm seeing that.
I know. So I guess that's my point, is that the market has made up its mind that the Fed's going to be focused on fighting the sluggish economy, trying to prevent that versus trying to fight inflation. But again, man, there is inflation still out there. You look at where gold is. I mean, getting back to that point, there are those worries have not gone away. They're simply been, brushed under the rug for now. And that rug's kind of lumpy. So it's like you step on it. It's like, what's that? I feel like there's something in it.
Things that are shoved underneath that rug, John.
Yeah.
Yeah, that's a good point. I don't know if gold is telling us about leading inflation. I don't know about that. I have a difference of opinion on that. I think it's more of a confidence in central banks kind of thing, which is not good. I mean, central banks, if there's one thing they need, it's confidence, because they run the currencies. And when currencies don't have confidence, it's a big, big problem. But I want to point out on this chart how look at all these other percentages, guys. See how low those are? I don't have any faith in that. Right. So all those other rate cuts that are in the future, they violate 2 of the rules. They're too far out in time, and the number is too low. The confidence number is too low. So that's how I think about it. You guys can do whatever you want. But as far as I'm concerned, 1 cut in September. This cut looks like it's coming in October, unless they cut twice and they do a 50. A half-point cut, which there's only 9.8% chance of that, so I don't know. And then you got another cut in December. 3 cuts for the end of this year. Now, I told you guys that if this table changes and these more cuts in the blue boxes move to the left, all these numbers move to the left, which is exactly what happened over the last week, right? That means that mortgage rates are going down. And that's exactly what happened. So what you guys need to understand is the Fed didn't even cut yet. This is the markets getting an economic number and then adapting their expectations on how much the Fed's going to cut in the future. That is what moved these rates down, not the actual cut itself. So the markets are moving on expectations of lower rates, and now you got lower mortgage rates that are pricing that in. That's what's going on right now before the cut even happens, John.
Yeah, and it's been really interesting because we've been watching, and I just like to watch the conforming rate because it's a little bit smoother than the jumbo. But I've been watching it slowly tick down, and it's just been this really, really slow downtrend. It's picked up speed in the last couple of weeks, obviously, because we had some of the news out there, especially with the jobs report coming out, which pressured rates down, which I guess also tick this down. But you draw a line from where that conforming rate is now. It's the lowest it's been. You go back to a year, right? It goes back to last October, which last fall was a pretty decent season. So look, I'm keeping my fingers crossed. I'm salt over my shoulder, the whole works, that this is going to shape up to be a decent fall season, because the luxury market's been doing its own thing and it's been pretty productive on its own. But it's isolated. You look at that sub 4 million in Manhattan, under 2 million in Brooklyn, that non-luxury sector, which is relying on financing for the most part. We're finally getting back into the realm where financing is like, okay, like it's a little bit less scary out there in terms of what those risks are. So, again, I'm holding out hope that this could shape up to be a great season for those people who've been on the sidelines for quite a while.
Yeah, we got a question here. What rates are you seeing out there? I think you're probably seeing jumbos below 6.5 or getting close to that 6.5 level right now. I mean, it's mostly a jumbo market, right? We do have a lot of cash. But I mean, if you have relationship banking, if you're buying some points that's going on, you're in the 5s. You're in the 5. I don't even know what the arms are, quite frankly. So you're seeing buyers are seeing the most attractive rates right now in the last couple of days. Yeah.
I was going to say that's a fantastic point. The idea that if you have a relationship, it's a great time to cultivate relationships with mortgage brokers, because there are some really spectacular deals out there right now. So but again, your mileage is going to vary, but it's a great time to have those relationships and figure out what that market looks like, because it's not it's not something that's widely publicized. You can go to like, some site like today's Manhattan mortgage rate with deals.com and you'll see everything. You got to kind of have that personal relationship. So,
right. We got another question here. John, isn't that what happened last year with the beginning of 2024's predictions? So I guess you're going right to, let's see if I can highlight this on the chart. We get that out of there.
yeah.
I think you're talking about this period of time right there.
What I think he's talking about is when the Fed cut rates last September, mortgage rates went up, right? So we were trending down, you cut the rates and the 10-year started rising on that.
Well, that was around here, I think. I thought he was talking about with the beginning of 2024's predictions. So I don't know. Maybe I have to have John clarify that. But this is constantly going on. I mean, this is what is constantly going on. As you get closer to the Fed making potential moves, all those economic reports get that much more critical. And the markets are just looking for any reason to change their expectations on what the markets are doing. Right. So all I see right now is we are going into a lower level of mortgage rates. I didn't expect it. I didn't expect it, but you got that jobs number.
I want to pop this up. Kara says, I have a client with a lot of my Schwab who just got 4.8% for market mortgage owned by Schwab.
That's what I'm talking about. Relationship begging.
Right.
There's some deals out there. If buyers are going to be stepping up, I mean, this is good stuff for our start of the fall season. I mean, I don't know if buyers are completely aware of the dip in rates over the last few days, right? It's only like less than a week old kind of a thing, but it's happening,
Yeah. But that's the thing, because it's been happening so slow, it's not really getting headlines. When the mortgage rates spiked up in 2022, it's just like, oh my God, look at mortgage rates. But then they do this like paper cut by paper cut lowering. It doesn't make the headlines because it's slow motion, but it's out there. So it's
out
worth
there.
Noting.
I will just point out, guys, that this move that we've just experienced is basically this table shifting in real time, right? So now we got to ask ourselves, now that it's priced in and this happens, where do we go from here? Right? What have you done for me lately?
That's right.
Buy your wife something, and it's like, 2 seconds later, it's like, all right, well, what have you done for me lately? That's where the markets are looking at rates, right? What have you done for me lately? So now that it's priced in, it's all about where we go from here, right? If the Fed does cut rates in September, 90% chance, that alone is not going to make rates go down because it's already happened. That's the important thing that you guys need to know. It's already priced in. Okay.
Great point. Yeah.
Brian's asking how much money. Brian, where were you on gold? I thought you were going to have something to say about this bad boy right here. All right. But you know what? Brian's probably collecting his thoughts and he'll call me afterwards. That's what he usually does. I also want to talk about something, John, that you mentioned about a year and a half ago on Macro Money, guys. There is a spread. There's a spread between 30-year mortgage rates, basically mortgage rates, and the 10-year treasury yield. It's a typical spread, right? That spread is usually around 2% or just above 2%. If you look at 23 and 24, John mentioned this. It was very, very perceptive of you, John. You mentioned that the spread between mortgage rates and 10 years is abnormally high, and that once the market eases that and that spread comes down, mortgage rates could move down a half a point, quarter point, 3/4 of a point without the Fed even doing anything. So I'm just pointing out to you that spread has actually come down. It's come down. It's about almost a half a point lower than 2 years ago already.
Yeah.
And it looks like about a quarter of a point.
It's been a very, they're trying to normalize, but it's been a very, very slow process. So
yeah,
it's great. Let's hope
it's good.
Keep going. Yeah.
And that's partially the reason, again, why rates are coming down a little bit lower is that spread is coming down. So that was a great call, John. I thought that was really way ahead of anyone. And it was nice foresight that you had there.
Thank you.
Brian says his 2011 prediction. That was 2008, Brian. Those predictions. You cheat me on 3 years. All right. I want to pivot to national really quick. All right, guys. Take a look at this top chart right over here. It's showing, this is typically from Redfin, this top chart. And we pointed this out before, but this is showing you whether or not there are more home buyers or more home sellers based on supply and demand metrics across the entire nation. And as you would expect, right after the pandemic, if you go above that zero line and the higher you go above that zero line, it means a lot more buyers are in the market than sellers. Okay. That period has completely reversed. You got an extreme over here. Now you got an extreme down here, right? Almost back to 2014 levels. There's a lot more sellers out there. Than buyers. And the Case-Shiller monthly percent change on that Case-Shiller national home prices has been negative for about 4 months now. So like there is a housing recession that is going on outside of our little world here.
Yeah. And this is one of the things we've been talking about. We've noticed this for the last, year or so. We've started to watch how inventory, especially in Florida, Texas, some of those hotter markets over the last several years have the inventory has just been steadily growing. And it's to the point where it's almost, it's become a buyer's market in a lot of these markets. Whereas in our market, inventories remains a bit of an issue.
Yeah. Take a look at this. We talked about it on Friday. Where's the inventory? If we looked at, for this analysis, John looked at the summer. He looked at the summer. It's like, let's take a look at the summer. June, July, August. Wait
a second. I just got it. Was that from like the Wendy's ad? Like, where's the beef? Where's the inventory? Remember that?
Where it's from.
That old
but nobody.
Where's the beef?
That's a Generation X.
I just got it. It took me the weekend to get that, but I got it. So
that lady was so angry in that commercial.
She should have been. She got stiffed on her beef.
All right, I want to talk about this for a second. June, July, and August. June, July, and August is the summer months, right? So John was questioning to himself, how many new listings came on in June, July, and August this summer relative to every other summer since 2008? And here's your answer, guys. I mean, and what's interesting about this inventory measure that we took is look at the two bottom bars. It's 24 and 25. So this is not like it's just starting. Last year was like this too. Look at the top. 2020, 21, and 22. So you got
2020, we even put the little asterisk there. That was the pandemic reopening. So for all the people who were like, I'd like to sell in April, it's like, no, you can't because we're closed. It's like that little sign, come back in July.
Come back later.
Okay. So they came back in July. So that bar is a little bit artificially inflated. But 2021, that was a big one.
2022.
2025. Not a big one
as well. So there's not a lot of stuff out there. There's not a lot of stuff coming on. I don't know. I mean, I don't know what it means. I don't know if it's going to extend into fall season. I don't know if it means typically sellers don't come on the market when there's no real reason to sell. Obviously, when they're not going to get their price, or they don't perceive the environment as a good sell side environment. They'll typically go off market. That's what happens. Like in the great financial crisis, you would have thought all this inventory is piling on the market out of desperation to get out. The exact reverse happened. It all went off market.
Yeah.
And that's what's different. I feel like Manhattan is, just to go back to this chart for a second, the national housing market is mature in a recession. Like, I don't know if it's the 5th inning, the 6th inning, I don't know, but it's been happening for a while now, years. Right? Especially on a volume level. It's been volume slump big time. Mortgages, applications, home purchases, etc. Manhattan just been kind of stabilizing, like price action. We've just been kind of going sideways. From a market climate point of view, it's been more challenging than it usually is, but we don't have prices falling off a cliff. Like from a price action standpoint, we're just going sideways. From a temperature standpoint, it's tricky out there. So I wonder if Manhattan is going to be the last one into the housing reception and then the first one out. Typically, that's what Manhattan does. It's the last one in and the first one out. It's one of those types of markets. Seems like that's happening here.
Yeah, well, you could make an argument that the sub-luxury sectors in Manhattan have essentially been in a bit of a housing recession because volume has just been low, and especially post, the Liberation Day, that volume just kind of disappeared and hasn't really come back. But here we are, we're approaching the fall season. We've got mortgage rates at attractive levels for the first time in a year, but we're short on supply. So, and plus the headlines out there are the headlines that people read on a daily basis when they look at the Wall Street Journal, New York Times, whatever it is, and you talk about national news headlines, they're pretty pessimistic on housing. Most of the news coming out of the housing front is sort of like, why would I bother with this? But to your point, all housing is local. So the stories that are shaping up here are different. And I think that's what's going to be the main challenge of this fall season is sort of getting that news across that like, hey, we're actually doing okay here. This is actually an interesting time for Manhattan and Brooklyn, especially given the fact that some of these things that are affecting the national scene are not necessarily affecting us, and affordability is actually starting to improve. So
yeah. Yeah, I hear what you're saying. It's not so bad here from a price point. From a listing temperature standpoint, again, let's just change this to Manhattan. I want to just point out one thing with you guys here. If you go to the climate index, okay, take a look. This explains a lot, in my opinion, about what's going on with our market. It's the temperature of the listing climate. Here you go. It's challenging. Look how low it is. And look what it's done since March. Like March was good. March is good, right? And then every single month after that has been kind of tough. I think this chart kind of explains what we're going through. But at the same time, prices, they're just kind of, they haven't done anything. They've just done a whole lot of nothing over the last 10 years. They're just stuck in this sideways channel, right? Interesting question, Johnny. How is affordability starting to improve and where?
Well, I guess the question is, it's more about that sub-luxury sector. And the idea is that if you're looking to get a mortgage, your rates now on a mortgage are probably the lowest they've been in over a year. So that's a good sign for a lot of buyers out there.
It's only, Kara, it's only in regional markets. A lot of regional markets are starting to see those prices start to come down. Now you got the rates coming down, but the rates coming down is not going to just on its own swing this, because you got some job softness that's going on now, right? And job softness is going through a little recession. Then buyers are going to kind of go on strike a little bit with you got to fulfill the cycle, right? It hasn't fulfilled itself just yet.
Yeah, I think there were some charts we left out talking about new residential construction. Obviously, this is a national thing, and it's starting to roll over a little bit. So you have some home builders starting to say, like, maybe we're going to pull back a little bit if supply is, building and buyers are soft. But again, in many places in New York City, new supply is more than welcome. So
yeah, I agree. Hillary, not the most accurate time to talk about inventory. Agents always tell the sellers to wait until Labor Day. Labor Day and listings are multiplying daily. That is 100% correct. We just happen to talk to a lot of agents anecdotally around the market, and all of them are like, there's not a lot of inventory going on. That's what triggered us to actually do that analysis on the summer inventory. But just to show you what Hillary is saying, I have a chart that shows this to you guys. If I go to monthly new supply, let me just give me a second to set this chart up. Monthly new supply, and I go to 1 year, and I go to seasonal average. I took out my actual prints. There you go. September 1757. It's the top dot. It's the top dot. The other two dots are here. 1710 April is the second month. So this is the best number one listing month. I think we mentioned that in the beginning, right? The number one listing month is now. So the question is, are we going to see 1,757 listings come on this market? Above, below, at, whatever. And the only thing I'm questioning is the whole mayoral election, which is kind of seems to be grabbing everyone's kind of attention over here. Does this push back sellers saying, I don't want to list into this or not? I don't know. Maybe they don't care. Maybe it's a non-event. I don't know. But that's the biggest question I have towards this. Everything else is good. Rates are lower, right? Rates are lower. The stock market's still going up. Things are stable. So it should be a decent fall listing season. If not, you got to ask, is there something local going on here?
Well, speaking of local, I like Kara's inside baseball comment. She writes, I think Street Easy listings will explode after September 15th because they just changed the rules. So anything off market 30 days over summer starts days on market at 0.
Yeah.
So,
what do you think about that?
Yeah.
What do you think about that whole 30 days thing?
We do our own days on market count because we're more interested in accuracy than resetting. But I mean, that's a different story altogether. But my point is, there's all these little things, and I think you have to, as an effective agent, you really got to pay attention to them. So, I mean, knowing when days on market resets for Street Easy and other sites is a great example of that. The other is understanding the price tiers that a lot of the listing services use. So when the listing portals use. So when you go and you want to set a price tier, is it a $250,000 gap? Is it $500,000 or whatever that is? Make sure you're not pricing just $5 over it, so you don't miss those buyers. But it's like little things like that are really essential tips and tricks. So good to know.
Yeah. Yeah. And that 30-day change, that's interesting. We do 90. we do. I think we do 90. You have to be off the market for 90 days to reset that days on market because we didn't want anyone gaming the system, kind of a thing. So now that got changed. It'll be interesting to see how that plays out in terms of inventory and relisting activity. Thank you, Kara. Good stuff. We're done. We did it.
We made it.
Only a few minutes. Only a few minutes over, guys. Unless you have any other questions here, we basically touched every single topic that we wanted to discuss over here. Will UrbanDigs keep their number of days on the market at 90? I mean, I'm not changing anything imminently. I don't know. We'd have to give some serious thought to it. I kind of think 30 is too soon, but I don't know.
Look, if you change, I mean, I think our rule is if you change agencies, we reset it. But
yes,
generally speaking, if you just take it off and you leave it off for 30 days and you put it back on, we just keep the clock going. I mean, that's kind of because it's still for sale. 90 days.
I mean,
okay.
Well, we want to be aligned with the industry, so we'll have to see how other people handle all that kind of thing. Any thought as to why Street Easy is doing this? Because it makes it look better for the seller? I don't know. Is it their answer to the off-market thing? I don't know. The private listings? I have no idea.
Oh, I don't know. I don't know.
Yeah, I don't know what they're thinking over there. But it happened, so we'll see. All right, guys, we're gonna wrap this up. I don't want to take too much of your time. Hillary, days on market is damaging to sellers and buyers. So they changed it and made it less, so it's less damaging, I guess. So it's more of a sell side friendly action. You know?
That's probably it.
Yeah, well, I'm getting some comments here. It seems like they're more worried about their overall website traffic. They get to notify their users every time a listing has a change. See, that's interesting, Christina. I don't know, but it is what it is. We'll have to see what we want to do here, Johnny. We're done for the third time. We're done for the third time. Guys, if there's a question you want to talk about, you could just send an email to Johnny. He loves
I'll take it.
John at UrbanDigs.com. Other than that, we're done here. Johnny, thank you so much for everything. I am Noah Rosenblatt. We're both with UrbanDigs. This has been Macro Monday, and we're going to catch you guys next time. Cheers.
Thanks, everybody.